Welcome back to the channel. My name is Steven. I'm a pharmacist and I own 54 units of real estate. So today I want to talk about a concept I learned recently called retirement assets. And by retirement assets, I'm not meaning retiring from your job. I'm meaning retiring from real estate. So conceptually, retirement assets are more passive. And to name them off a few, it's going to be triple net leases. So imagine owning a building that leases out to Starbucks, CVS, Walgreens, something like that. So it's an absolute triple net where you just pay, as an owner, you just pay the mortgage. And then the tenant, like Starbucks, they'll pay everything else. They'll pay the property tax, they'll pay the insurance, they'll pay the repairs. So it's mailbox money. And the pros and the cons of triple net is pros, obviously it's super passive. You don't have to do anything. It's like owning a bond. You can do a cost seg on it to wipe off active income. The con is that if Starbucks were to leave, the value of that asset is based solely on the tenant. So if Starbucks decides to leave, then that building is not going to be worth much. It's going to take a long time to rent out that building. And you have to do something called TI, or tenant improvement, for the next tenant, whenever that is. So there's always pros and cons, but conceptually it's more passive. You don't really do much besides collect your rent, and then you use that rent to then pay the mortgage, if there is a mortgage. So what a lot of people do is they may start off in apartments, C-class apartments specifically, and then they will trade up to B-class because it's newer, less CapEx, less, better tenant base. Then trade up to an A-class tenant. Once again, newer, better tenant base, but more amenities. So if there's more amenities, could be more headache. And once they get sick of dealing with tenants, toilets, and all that stuff, they tend to exchange typically into retirement assets. Triple net lease is one of them. So first retirement asset is triple net lease. Another retirement asset I would consider is, I would say, A-class apartments. I think in general, apartments are a lot more work, but if I were to compare a C-class to an A-class, I think A-class will have fewer maintenance issues. I may be wrong, because like I said, once again, A-class apartments typically have a pool, jacuzzi, gym, dog park, rec center, common areas, lounges. So with that comes more repairs, but the lounges don't require much maintenance. The business center doesn't really require much. It's probably just the pool, and the jacuzzi requires maintenance. And the gym, I'd say it's minimal besides cleaning and unless equipment breaks down. So, but like I said, you're getting better tenants who auto pay. In A-class, typically you're gonna get white collar workers, working professionals. So hopefully it's a better tenant base, and since it's a newer asset, you shouldn't be having to deal with HVAC, plumbing as much. But with that, if you have higher paying tenants, they're typically gonna be more demanding, have higher expectations. So, like I said, I would say conceptually, if you're kind of trading up to A-class assets, you're on the path towards retirement. So like I said, like for me, most syndicators and most multifamily investors, myself included, got started in C-class apartments. What's C-class? C-class is 1960s and older. Typically it's been owned by somebody for a long time. So the one I bought, he owned it for 30 years. So it's owned free and clear. He was 68, wanted to retire, self-managed it. He did his own maintenance, did his own pest control, used one unit as his office for his law firm. So, this is your typical makeup of a C-class smaller asset, and you're going to go in there, and typically they haven't raised rents in a long time because they self-manage. So when you self-manage, you're not motivated to raise rents, because if you raise rents, they may leave, and if they leave, you have to do your own repairs, your own make-readies, and then lease it out again. So it requires too much effort. And these landlords typically own it free and clear, so they're not like maximizing like return on ROI. They're just more optimizing, like I'm happy with this cash flow, and eventually, they sell it, they pay Uncle Sam, and then they take that nest egg for their retirement. So exactly what the guy I bought from did. So when I took over, this requires a lot of work. I have to renovate all 26 units, new roof, replace multiple electrical panels because they're recalled, replace multiple water heaters, had to get new flooring, new ceilings, new bathrooms, new kitchens, new exterior paint. You have to deal with plumbing issues. So there's a lot of work that comes with C-Class. So this whole process of like renovation and basically I'd renovate 5 units, rent out 5 units, renovate 5 units, rent out 5 units, then all in all, to get all units renovated, to finally stabilize with a new tenant base, because obviously when I renovate, I'm increasing rents from $350 on average to $700 on average, which is still below market rent. So this whole process takes 2 to 2.5 years, and you're dealing with contractors, and you're dealing with a lot of funding for renovations. So it's more work, right? But thanks to C-Class, I'm able to force a lot of appreciation, which is why a lot of beginners start off in C-Class. So I bought it for $500,000, put in $300, all in $800, and now it's worth 1.6. So I forced $800,000 of appreciation, and then from here, I didn't cash out or refinance the deal. So I still kept my down payment in the deal. I kept my renovation costs in the deal. I kept the same loan. So my loan's only $350K at the original purchase price of $500. And I could have easily did a huge cash out refinance because it appraised for $1.6 million. Could have easily pulled out, let's just make it $1 million. Pay off or I could have put out, if I really leveraged it, $1.2 million. And let's just say I paid off my loan of $400 for easy math. I could have put out $800,000 tax-free. So I would have put out my $300K in renovation costs and would have put out $500,000 tax-free on top of that. But my monthly loan payment would be probably $8,000-ish. And if that was the case, $8,000 to $10,000 would be my loan. And back then my interest rate would have been probably 5%-ish. No, actually, take that back. This would have been during 2023, so it would have been 6-7. So my monthly payment would be $8,000 to $10,000 a month, and I probably wouldn't be cash flowing if that was the case. So thankfully I didn't cash out refinance, I didn't leverage, I didn't do the burr, and from there, a lot of people, they own C-Class, and then what kills C-Class is that you have a lot of CapEx issues. These units are older. Yes, the inside units may look nice and new, but the infrastructure is old. So you have old plumbing, you have old electrical systems, old water heaters. So this is what's going to keep on hitting you, right? This is what happened to my 20 unit. I have a lot of HVAC issues, a lot of plumbing issues, a lot of condensers and AC units are breaking during the summertime. So because of that headache, people then trade up from A class to B class. So let's just say you sell your, let's just call it 20 unit C-class apartment for $1 million, and then you buy a B class, let's just call it 10 unit, for $1.1 million. And then once you get sick of that, so B class is about 20 to 50 years old is the range. C class is, I'd call it 50 years plus. And then once you get sick of that, you go from a B class, you tend to change to A class, which let's say you might buy a 5 unit, $1.2 million A class asset. So it's fewer units, higher price, but higher rents typically. So usually you have to work your way up, right? So I would consider A class apartment complex more of a retirement asset, but it's not the most retired asset, right? So number 1 was triple net lease to like a corporate tenant. Number 2 is A-class apartments. So the next retirement asset is, I would call it like commercial or retail strip centers. And like imagine you see like a strip center, or there's like a grocery store there. That's called the anchor. So let's just say, in the Bay Area, and here it's called like Vons or Albertsons is the anchor store, or Safeway. That's the anchor store. And then along next to Vons, Albertsons might be like a haircut shop. You might have like a restaurant. You might have a, I don't know, a Dollar Tree or something like that. Or Dollar Tree can be an anchor store too. You might have, a boba shop. You might have a coffee shop, something like that, right? So let's just say you have a strip center. There's like 5 units there. One's an anchor. So typically anchor could be a laundromat, grocery store, Dollar Tree, and then you might have a hair salon. You might have a tax accounting firm there. You might have a restaurant there. You might have a little gym, right? So some type of asset that you think that people go to a lot. Maybe it's a nail salon as well. So usually you want something that's an anchor, that's bringing the business. So you want like something good there. And then you might have like a haircut place. I think haircuts are pretty recession resistant in terms of their business because I think people always need a haircut. You might have like a little business there, like you said, a little tax accounting firm or a print shop. You might have a little restaurant. Those are more volatile. You might have like a boba shop. Some sort of little business. So these are typically double net, which means I think they pay their own repairs, and then they pay, I forgot, I think the landlord still has to pay like property tax or insurance, something like that, but it's typically like double net or triple net. And like I said, once again, once you have a tenant in place, it should be more passive. But like I said, once the tenant leaves, so the downside of business is that like, if shit hit the fan, if we had a recession, you don't necessarily need your business, but you always need a place to live. Like during hard times, you don't necessarily need your business, you need a place to live. So that's why I'm kind of wary of strip centers, but conceptually, they're more passive because once again, they just pay you rent every month and they'll take care of their own, like if their like kitchen has issues or something, then the tenant will take care of it themselves. Like when I owned a pharmacy, I rented a space in a strip center. It was anchored by a grocery store, and I had to pay rent on a per square foot basis. And from there, I had to, if I had issues with toilets, I had to make those repairs myself. But typically, there's not that many repairs that need to be made. And this is like more passive, but not as passive as like absolute triple net. So it's another asset that a lot of people trade up into. So I would say these are the 3 type of retirement assets that I know off the top of my head, because like you basically want something that's more passive, that is more focused on tax advantages. So when you're ready for retirement from real estate, most likely you have a high net worth. Most likely you built your net worth through C-class apartments and trade up to B-class apartments and trade up to A-class apartments, and now you're trading to absolute triple net. Or maybe you started in mobile home parks, made your money there, trading up to triple net leases. Maybe you made your money through self-storage, trading up to triple net leases. So you want something that's like not as labor intensive, like mobile home parks, very labor intensive, apartments, very labor intensive, versus like imagine if you owned a portfolio of like 7 Starbucks buildings. That's pretty passive, right? Because Starbucks just pays you every single month and they take care of everything else, and as long as the lease renews, you're good. You don't have to worry about basically the lease getting renewed or not renewed. So that's the downside. Yeah. So from there, it's really about that passivity. It's really about not focusing as much on return on investment, but just return on your time, and then wanting to take it easier. So I'm curious in my mind, like, am I ever get to this point where maybe I'm sick of single family homes, maybe I'm sick of my small multifamily, and maybe I'm tentatively exchange all this into like a Starbucks or a retail strip center. These areas aren't my expertise, but maybe that'll be the path that I go. So I met a triple net lease broker before, and he said that a lot of people they made their money in apartments, self-storage, mobile home parks, want it easier, and they tend to exchange into triple net leases where they're almost like bonds. It's mailbox money, and you just take the tax advantages of triple net leases that have to offer. And at that point, you're typically not living off of the cash flow because you just made so much money, you build up so much net worth and equity. So it's a different game. It's a game for I'd say that the wealthier. I think Ben Mala has done this apparently, where you start off in apartments and trade his way up to triple net leases and owning malls and strip centers, because it's more active or passive for the most part and easier to manage. So this goes to show you that when you invest in real estate, you have to constantly evolve, right? Like I started off house hacking with 10% down, where I lived in the master bedroom, rented out the other bedrooms. That's how I got started. And then from there, I went to out-of-state investing because it's cheaper out of California. And I bought in Oklahoma and Huntsville to get my feet wet. I'd never, been in Oklahoma or Alabama, and bought my deal there, then visited those areas for the first time. And then from there, I went into small apartment complexes out of state in Oklahoma in a mobile home park. I bought my first apartment in Oklahoma, bought my first mobile home park in Selma, Alabama. My 26 unit that I bought is doing great, still own it today, but it's a lot of work. But that's how you get started, especially if you don't have as much capital as me, because I just work a W-2. I'm lucky that I make a decent amount for W-2, but compared to business owners, I don't make that much money. Obviously if I made more money, I wouldn't have to go through this progression. I just can go straight up to the higher quality assets. But start off in C-class value add, and then mobile home park started with value add mobile home parks, and we all know how my mobile home park went. Sold that for a loss. And then from there, haven't progressed to that next level yet because I haven't reached that next level of wealth. But like, what's the next step from here, right? Is it maybe I'm going to triple net? Maybe I'm going to 1031 exchange into B-class apartments. It's the most logical step, or to an A-class new construction to reduce the age of my portfolio. That's what I may be doing. And then from there, like I said, maybe go up to A-class, maybe go to triple net. So you're constantly evolving, and it's okay to what a strategy that worked, for you 10 years ago may not work for you today, because your situation changed, your wealth situation changed, and your knowledge exponentially improved, right? So you gotta just go with what you know initially, and then just know that you may change your mind. You may like something else down the road, right? If you look at Brandon Turner, he started off doing house hacks and burrs, single family, and now he syndicates mobile home parks and larger apartments, right? And for him, it's not worth it to take down a little house hack or a little burr right now. So like I said, you have to go different levels. And I created a video recently, new levels, new devils, right? So as you progress, there's going to be more problems and more issues that you're going to have to deal with, and more issues and stressors that you never experienced before as you elevate up. So if I'm privileged enough to trade up, like I said, I'm most likely going to be trading up to a newer apartment or newer assets. I already kind of bought 2 new construction, and want to sell my 20 unit to use that to build 2 ADUs, which is basically new construction. So I wanted to lower the age of my assets, and then also increase the quality of the tenant, and increase get higher rents because I have higher quality tenants, instead of dealing with $500 per month rents. I'm getting a couple thousand, right? Like 2,000 to 3,000, which is easier to deal with, right? Fewer doors, fewer tenants, fewer toilets, so more passive. So that's what I'm kind of doing right now. And I know this investor I've been networking, Cody, he's basically 1031 exchanging his C-class apartments. I think there might be 15, 20 units into a 7-unit A-class asset. And it's a little bit more expensive, fewer units, but higher rents. So it all works out in that way. Another retirement asset a lot of people do is they might just seller finance all their deals. Let's say you own your whole portfolio free and clear, and then what you do is you seller finance a deal to a newer investor, and then you just collect mailbox money. You become the bank, right? So imagine I sold my apartment complex that's owned free and clear for $1 million, and then I just sell it to the investor for 10% down, and I carry a note of $900,000 at 5-6% interest only. And then that's my mailbox money every single month. So this one's even more passive because you just become the bank, right? So this is another, I think that's what Pace Morby plans on doing. He just plans on seller financing his whole portfolio, and then basically becoming the bank and then collecting this easy mailbox money one day. I think that's his ultimate plan with his community, is when he's done, He just wants to seller finance this to his members in his community or to sell it to an institutional buyer, and then basically just collect very, very easy mailbox money. So that's the name of the game, the progression. So anyways, thanks for listening to my rant. Hopefully you found value. If you want to, let me know what questions you have. If you want to join my school community, if you want coaching courses, you want a steadily landlord insurance quote, please check out my link tree down below. From there you can also send me an email. Otherwise, please like, comment, subscribe, and hope to see you in the next one. Thank you so much.